Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, March 5th, 2021. And here are our top stories. College endowment returns tumble and financial distress and transparency at America's colleges and universities. Well, joining me now to discuss this and more is Rick Seltzer. He's an editor with Inside Higher Ed. Rick, great to see you. Thanks so much for joining us on the program this morning.
Great to see you too. And as always, thanks for having me.
Yeah, and I think it's always great to talk to you about college. Great to talk to you about what's happening in higher education. I think the first thing you wanted to talk about were the endowment returns, which were among the lowest since 2016. What can you tell us here, Rick?
That's right. Every year, I think it's very important that we track what's happening with college and university endowments. Endowments are not the largest source of revenue for most institutions, but they're an important one, and they're a very large source of revenue for a select few. Anything that happens in the endowments in one year can affect finances for years to come. So this year, amid the pandemic, or the first few months of the pandemic, were picked up by this particular report. It's important that we saw the lowest average net returns since 2016. It was about 1.8% on average across all of 700 plus institutions that take part in this particular piece of data gathering, which is the best one that I know of. So again, lowest returns since 2016. This is for the fiscal year ending in June of 2020, however. So we can all remember what happened back in the spring of 2020, had that big dip in the markets. It was climbing back. As of then, depending on your investment mix, your portfolio may or may not have recovered and gone on to do some very different things since then. So just remember, this is a snapshot in time. However, it's an important snapshot in time because what happens in one year affects how much these institutions feel they have to spend in future years. They are all seeking a 7.5% average net return over 10 years. And so a drop one year can really influence what their 10-year return looks like.
Really good point, Rick. What typically are endowments used for? Just to be clear for the audience, are they used for capital project improvements? Are they used for hiring professors? Is it used to offset some enrollment losses or some tuition?
It's a great question, and it's a really important one because I think the popular perception is sometimes that they're just this slush fund that colleges and universities have access to, and that's not the case at all. As a lot of viewers here know, as good informed finance people, endowments are used for all of the above of what you just talked about. Oftentimes, they are a compilation of funds that are restricted for various purposes. Sometimes they'll be restricted for financial aid. Sometimes they'll be restricted for endowed chairs or professorships. You'll see people with titles that are endowed professorships very often. Research they go to. And then sometimes there is an unrestricted portion. That's like the holy grail if you're a fundraiser. Can you get some unrestricted money for the endowment? The other kind of important thing to note about endowments not being a slush fund is that they are structured to hold their value over time. So you can draw down an endowment in a year or two or over a year or two, but over time, if you're doing this as a good fiduciary, you're actually structuring the way that you're drawing so that the endowment holds its spending power. Most places target a 5% spend and then factor in, I think it's about 2.5% of inflation so that they hold their spending power. So they're looking for a 7.5% rate of return over time.
Rick, is there a difference when you looked at the data? Is there a difference between some of the Ivy League endowment returns versus maybe some, I don't even want to say lower tier, but let's just say they're non-Ivy League, maybe they're just private colleges, public universities, et cetera?
Yeah, so the biggest split, or I think the most important split, is between endowment size. And one really interesting thing in this year's set of returns is that the smallest bracket, the endowments with under $25 million in assets, actually performed just as well as those with the over $1 billion in assets. And everyone in between was kind of in the middle. Now, we're talking about a percentage point or two here, so there's not a huge spread. But that's relatively uncommon in recent years. What's been happening is different endowments of different sizes invest differently. The smallest endowments tend to be more heavily weighted in bonds. because they're concerned about losing the corpus of the endowment. They're concerned about losing that value, because it is actually very important, even if it's small. They tend to be small institutions, and the small amount that they draw from that can be very important to making the budget. Those over $1 billion tend to be more heavily invested in alternative asset types, broadly speaking, alternative asset types than other institutions. So you'll see venture capital, private equity, those kinds of investments, some hedge funds, that kind of thing, illiquid assets, because frankly, they have the assets to be able to tie things up over a longer period of time. You'll see more public equity kind of in the brackets in between with some varying breakdowns. But because of that, in any given year, particularly when the public market is doing so well as it has been in the last few months, we might see some real divergence here going forward.
And Rick, I'd be remiss to ask you, it's a topic we've covered numerous times on the network about ESG, divestment. Did the report give any sense? 2020 was a incredible year for ESG and sustainability investments, a lot of that being led by endowments and foundations. Any sense for what the impact was, positive or negative, to endowment portfolios?
Yeah, the survey just started asking about ESG. This was the first year they did it, so there's really no good comparison point right now. I think only 6% of institutions that answered a question about whether they had a formal diversity policy for asset management said that they did. In other words, do we try to select diverse asset managers? Obviously, under ESG, that matters for the governance issue, but also if you're concerned about different perspectives potentially boosting your returns. And I think that was probably the most interesting finding right now. I think going forward, we're going to have to be very careful looking at what things look like. Actually, I should add, there was one other top line finding. The survey folks asked if institutions had any environmental, social, and governance policies and ESG policies. 4 in 5 said ESG factors are reflected in their investment policies. 19% said endowments include responsible investing criteria in their public equity portfolios. 16% did so for global equities. Like anything in ESG, I think we're going to have to dig down a little further to know exactly what those definitions mean, how they're being applied differently in different places.
Yeah, I mean, I kind of consider, this is me personally, I kind of consider sustainable and ESG investing as almost an alternatives class, because in an alternatives class versus a traditional equity or bond portfolio. Rick, I want to leave it there, but we come back, we'll talk to Rick more about financial distress for some of our public and private universities, and also transparency, a real important topic. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Rick Seltzer. He's an editor for Inside Higher Ed. Rick, thanks as always for staying with us this morning.
Pleasure to be here.
And I told you this offline, but I'm going to embarrass you anyway. I love the blue shirt. Great color blue. So let's jump in and chat about transparency, but also financial distress. So let's start with transparency. This is something that you have harped on, not harped on, but we've talked about this on and off for the last year plus on the network. What's an update on transparency? Are we seeing more transparency, or are people at these colleges and universities still trying to keep some of that stuff swept under the rug?
You can fairly say that I've harped on this. As a reporter, transparency, free flow of information, I'm allowed to harp on those things. I'm almost required to, so I love it.
Didn't want to put words in your mouth, Rick.
No, it's fine. I those are good words. We had one interesting case come up a few years ago that basically the legal wranglings of those involved was just resolved. This was the College of New Rochelle, a New York City area college that spectacularly fell apart because of financial problems and ended up closing in 2019. There were a lot of hard feelings there among various staff and faculty members and how it came together. But one key point in the history of this collapse is that colleges and universities, this is a private nonprofit college, they are required to file a certified audit, just like most organizations. And so the question is, when this place fell apart, there was some documentation that did not appear correct in the history of its audits. And the question is, how did this happen? Back in 2015, KPMG folks approved an unmodified audit opinion, and according to the SEC, they did so even though they had difficulty finishing the audit because the controller at the college had provided, I'm quoting here, inaccurate, incomplete, or contradictory information. Yet higher ups at the college who had employed them to do this audit put some pressure on them to essentially issue it very soon, or they would be in trouble. The college would be in trouble. And these auditors did so, allegedly. And just recently, the Securities and Exchange Commission had brought them up for alleged improper professional conduct. And they ended up agreeing to a suspension. They did not admit or deny the SEC findings. But they'll be suspended for at least 3 years and 1 year. These are two individuals. So 3 year and 1 year suspension, respectively. They'll have to apply after that. So this situation, according to the SEC, actually led to the college's net assets being overstated on its certified financial statements by $33.8 million, which is a significant amount of money for a college.
That's not like a quarter or $1,000. That's significant.
Right, and these are statements that get published to bond investors. You know, I actually use them because the audits are up there. I can find them in the same disclosure channels that bond investors have, and I trust them more than other documentation. So somebody very well may have ended up taking a hit because of this misstatement.
So Rick, I mean, what does this mean for transparency? I mean, presumably, when you go through an audit, you have to get a CPA, typically a CPA firm. You mentioned KPMG did it. And then there are people at the top of the university who have to sign off after KPMG signs off. What does this mean in terms of overall transparency? Was there you mentioned that there was a sanctioning process that went into effect, But what does this mean for overall transparency? Are we going to see more transparency for colleges, universities, especially on the private side? Because that would certainly impact, if I'm a student or a alumni of an organization, I'm giving money, I'd want to make sure that the money that I'm giving to the organization or the school that I'm going to is financially sound.
Yeah, I should mention real quickly, these are former KPMG auditors now. They've always been
Sure.
referred to as such recently. So I just have to make that clear so I don't get a call from KPMG. But your question about, is this a step towards more transparency, is an open one. I've been in various venues where folks have really been concerned about both public and private institutions' transparency. I was at a bond buyers conference last year where some of the analysts were really concerned about the state of transparency. The only way they can pry some of this information out of institutions is if they are doing a placement or if there is continuing disclosure requirements. Otherwise, they're waiting for the audit like everybody else. And the audits trail by months at the very least. Sometimes you can go more than a year before that thing shows up. So it's of concern to investors. It has been of concern to regulators when places have fallen apart too. There was some legislation in Massachusetts that passed a little while ago that maybe will make things more transparent. And then at the federal level, there is just a whole mess of discussion about whether institutions are rated properly financially, which regulatory body has the proper channels or is the proper channel to regulate them, whether we should come up with a financial stability metric as opposed to just having them publish in a timely manner all of their different documentation on things like cash flow, assets, et cetera. It is, honestly, it's a real mess. And I don't necessarily see it being resolved anytime soon, unfortunately.
Yeah, sounds like there need to be some better standards set and adherence to those standards. Rick, what does this mean for, do colleges and universities here in the States get bankruptcy protection? Like say a college, the Jeff Snyder College, a very prolific college, goes bankrupt or is running out of money, has a negative balance sheet. Can you seek bankruptcy protection under U.S. law?
You can. However, you will be cut out of the most important source of money for most colleges and institutions, and that is federal financial aid. If you have a child of high school age, you've probably heard of the FAFSA. You fill it out, you send it in, you see what kind of federally subsidized loans you may apply for. If you are of low income status, maybe a Pell Grant, maybe some work study. Colleges and universities have to participate in that program for you as the student to be able to receive that money to subsidize your attendance. If I am a college or university under current regulatory interpretation and I declare for bankruptcy protection, I am kicked out of the federal financial aid programs forever, the Title IV programs forever. I cannot get back in. Title IV programs are a significant source of money, a very significant source of money for most of your run-of-the-mill average size institutions and below. So getting kicked out is essentially a death knell. In other words, bankruptcy reorganization, it isn't an option for these institutions. And that's potentially a pressure for why you'll see a place like New Rochelle have to take extreme, maybe even unscrupulous, potentially, allegedly, measures to try to fix things. It's not always necessarily that they are motivated by bad intent. They just don't have a lot of other options if they're on the ropes. There isn't a great wind down process, and there isn't a great reorganization process.
Yeah, and that leads me, I got about a minute left, but I mean, do you think that this pandemic has obviously seriously impacted lots of business, lots of not-for-profit, lots of schools? Do you think maybe that gets revisited? Because the purpose of a Chapter 7, Chapter 11, Chapter 21, I think it is, bankruptcy, I can't keep them straight, but it's a restructuring process that allows you to kind of reconsolidate, figure out your management process going forward, how you're going to restructure your debt sheet, et cetera, your balance sheet, et cetera. It could be helpful rather than see colleges and universities collapse or get consolidated.
Yeah, there's a similar process available in Canada. Laurentian University, a university there, followed or is following a restructuring process that's similar to US Chapter 11. But in the US, we basically haven't had this available since the 90s because a group of institutions, according to congressional hearings at the time, were hauled in front of Congress because they essentially use the bankruptcy process. And then some of the executives had an allegedly big payday. This was in the 90s. Essentially, they wrote out the bankruptcy process effectively from regulations after that. Whether or not anyone has the appetite to reopen that, I don't know. I think it's a hard sell while bankruptcy is not open to students for their student loans, but those two things aren't necessarily linked to each other.
Yeah, well, I guess we're going to have to see how this all plays out, but I do get a sense, just talking to you and kind of just doing some reading on Inside Higher Ed and other sites, that there's going to be a lot of financial distress, and there needs to be a way to release that pressure. Rick Seltzer, it is always a pleasure to talk higher education and more with you. Thanks for joining us. We look forward to having you back on the program again very soon.
I look forward to it too. Thanks.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow for BRN Weekly. We've got a very special guest, and we'll take a look at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.